Hello and welcome to our workshop today. I'm TC. I'm a banker at M&T Bank over here in Mahwah, right next to the Acme.
And I'm Angel, also from the Mahwah branch.
We're here today to talk to you about the first steps on home buying, what you need to do, what you need to, there's a whole lot of major decisions that need to be done. But we're here to help you out, to help you familiarize with the home buying process. You'll learn how to prepare for a mortgage, understand the terms of a loan, review the one-time and ongoing costs associated with home ownership, and explore methods to build your personal and financial readiness for home ownership. So let's begin with an overview of the topics we'll cover today. So today we will review the costs and responsibilities associated with home ownership, as we said. We'll explore the loan and repayment process, and we'll learn how to find out if you are financially ready to own a home. That is a big one. By the time we complete this course, you should have a better understanding of how to begin working towards home ownership. Many people are unclear about the benefits and challenges associated with owning a home. Let's take a minute to review some of them.
Okay. Though it's great to own a home, it's important to understand what's involved. What are the benefits of home ownership? Are there any negatives? Let's review some of the pros and cons of owning a home. Okay, so we're going to read some statements, and let's see if you think this is a pro or a con. So, for instance, we can say that your home is an asset. So, is this a pro or a con? You need to make payments towards a home. Some of you may think this is a pro or a con. I think it's kind of a con. You need to pay taxes on a home. Is it pro? Is it a con? Most likely, nobody likes to pay taxes. And you can remodel your home any way you like. So there are many risks and rewards to owning a home. Let's learn about whether the statements we just discussed are true or false.
So, first one, your home is an asset. That is both a pro and a con. The value of the house can go up over time, which is great, but it's also a possibility where it can go down as well. Not so great. So, you gotta weigh out where the house is located and everything on those matters. A home is generally considered an appreciating asset, meaning its value increases over time. However, it's important to understand that real estate values fluctuate both upward and downward. There is no guarantee that you'll eventually sell your home for more than you paid. The long-term value of your home can depend on factors beyond your control. If you have to move for work or other reasons and you're forced to sell when prices are low, you might end up losing money. It's also not as simple as selling the home for a higher price than what you bought it for. If you spend money on repairs, maintenance, renovations, you might not be able to recoup all of that money even if you sell your home at the higher price. Not all renovations increase a home's value. If you buy a home strictly because real estate generally increases in value, things might not work out as planned. Viewing home ownership as investing in a place for yourself and your loved ones is a much healthier outlook. If you get to use the house productively over the years, it might be worthwhile even if you can't profit from it. So what are the pros and cons of you need to make payments towards a home? So one of the pros, a portion of every monthly payment goes towards the principal, which is the amount you borrowed from the lender, and gets you closer to fully owning the valuable asset. The con, though, is you need to make large down payment upfront, monthly payments, and other one-time and ongoing home ownership costs. On the downside, buying and maintaining your home will cost you over the years, and making your monthly mortgage payments might be stressful at times. But ultimately, buying a home is a forced savings plan. In the end, you will own the house. Even if the value goes down, you'll be better off than if you had remained a tenant. Next, what are the pros and cons of the idea that you need to pay taxes on your home? Pro, homeowners may be able to deduct mortgage interest and property taxes on their income tax return, which is fantastic. Con, though, you must pay property taxes, which you won't be responsible for as a renter. Your local government will charge you taxes to help you pay for the services they provide, but up to $10,000 of that money might be tax deductible. That's always fun to know. If the monthly amount you spend on your housing expenses is more than you would have paid in rent, this tax deduction might help balance the scales. What are the pros and cons of the idea that you can remodel your home in any way you want? The pro, you can renovate and decorate your home according to your tastes. Whatever you like, you can do to it. You can paint the walls, you can do whatever. But the con is you are responsible for all of the repairs and maintenance costs. Owning a home means that you're the boss. You can decide to paint or remodel as you please, but you're also the one who has to pay the plumber when you have a faulty faucet. Have any of you thought about homeownership pros and cons before? Are there other factors that might be pros and cons that we haven't mentioned? Just think to yourselves which pros are most important to you and which cons bother you the most. It's helpful to write it down on a list, and if the pros outweigh the cons, then you're ready. So far. Knowing the pros and cons of home buying gives you a realistic approach towards homeownership. Now let's talk about what we can do to prepare yourself for the process of buying a home.
Okay. So most people cannot afford to purchase a home without borrowing money. Typically, home buyers will obtain a loan through a bank, credit union, or similar type of lender to help pay for the purchase of the house. This type of loan is called a mortgage. To obtain a mortgage, it's important to understand what lenders look for in a borrower. So let's review some of the common terms you'll hear now as we discuss mortgages and when you eventually apply for a mortgage. So we have income history, and we might know that income refers to how much you earn, but why are income and income history important to a lender? Right? So income and income history inform a lender whether a borrower will be able to afford to repay a mortgage loan. Okay, so what is debt to income ratio? Debt to income ratio, also known as DTI, is a percentage that tells lenders how much of a person's monthly income before taxes will go toward their debt payments. Lenders prefer to loan money to people whose expenses are less than 43% of their monthly income. We'll discuss DTI in more depth later in this guide. Okay, why are credit scores important to a lender? A credit score reveals whether a person repays their debts on time. A very good or exceptional credit score indicates that you're likely to make your mortgage payments and are therefore worthy of a loan, assuming you also have the income to pay for it. You may qualify for more favorable loan terms as a result of a good credit score. Why is down payment important to lenders? A down payment is generally a lump sum of cash that you use to pay for part of your home purchase. Having enough money for a down payment shows lenders that you are committed to the purchase and that you will likely repay a loan. Your ability to save money also shows lenders that you're capable of maintaining a safety net in case of an emergency of unforeseen circumstance. The top 3 reasons people default on loans are: 1, family-related changes, for example, a new baby, or the sudden responsibility of caring for an elder, causing expenses to increase. 2, an accident that requires medical attention or time off of work, causing expenses to increase and possibly income to decrease. And 3, a change in job status that causes income to decrease. Lenders prefer candidates who are low risk, meaning those who are well prepared to pay their mortgage even if their present circumstances change. So a major concern for lenders is typically, can you repay your loan? Borrowers who have steady income, savings, a good credit score, and a good DTI are typically considered low risk and more likely to pay their mortgage on time. On the other hand, a person with insufficient income, little savings, poor credit, and a high DTI is viewed as more likely to default on a loan and consider a higher risk. So being a good low-risk candidate for a loan is one of the factors that determine the amount of money you can borrow and the interest rate that you will receive. Let's look at how you can prepare to be a good candidate for a loan.
All right. For any type of loan, lenders generally use 5 criteria to determine the creditworthiness, also known as the 5 C's of credit. Knowing them can help you prepare to become a good candidate for a mortgage. Lenders use the 5 C's to determine if they should lend you money. The first is capacity. Is your ability to pay your bills now and in the future? If you have a steady job or a profitable business, lenders will trust that you'll be able to pay your bills on time. The next is capital, and it's readily available money and savings, investments, properties, and other assets that you could sell fairly quickly for cash to pay back the loan are also considered capital for a mortgage. Assets are any items that have significant monetary value. The next is collateral. Is property or other possessions of value that you can put up as security against your own loan. So for a mortgage, that would be the house that you're buying. That is the collateral. Character. Is your history of delivering on commitments. If you pay your bills on time, you will be considered a low-risk borrower. And then conditions are general circumstances of the borrower and the loan, such as the purpose of the loan, factors that might affect your ability to repay, and similar conditions that might impact the loan in general. So, how could you show capacity to pay bills now and in the future? Responses that might include, your employment history, current pay stubs, or earnings from your business. Some examples of capital would be cash, savings, investments that you have, valuables that you could liquidate quickly. Collateral would be cars, motorcycles, land, other homes, or other valuable items. For a mortgage, specifically though, the home you're borrowing the money for is the collateral for that loan. How do you demonstrate character to a lender? It's basically establishing a history of making on-time debt and bill payments. A good credit score always shows good character. What are some conditions that will positively affect how a lender views your mortgage application? Showing you have enough savings for a down payment, plus some reserve money, or applying for a loan that's well within your means to repay. Another step towards homeownership is having an accurate picture of your current financial situation and understanding how it relates to the home you will buy. This step has 2 parts. First, we'll take a look at the 2 5 C's, capital and collateral, and then we'll discuss debt-to-income ratio. Capital refers to cash, savings, or any other asset that you own that has significant value, such as car, real estate investments, or jewelry, that you could quickly sell for cash. To determine your personal capital, list all the items that you have that would go into that and their approximate value. Knowing the value of your possessions is important because it can show lenders that you have assets with cash value that could be applied to loan payments if your income ever becomes an issue. Collateral is an asset that the lender uses to security in exchange for giving you a loan. When you obtain a mortgage, your new home will be collateral that guarantees the loan. That means that if you miss a mortgage payment for a period of time, the lender may take your home. If you don't have much of a credit history, lenders may feel more comfortable giving you a loan if you have that collateral to secure it. People who have limited credit history will find it easier to obtain a mortgage or a car loan than a personal loan where there's no collateral. Now that you have a basic understanding of some of the important terms on how your assets play a role, let's discuss how you can assess if you are ready to buy a home.
Okay, so by using spending and saving action plans, you will be better able to evaluate how you spend and save your money. These tools will enable you to see areas where you can cut costs to save money for things you really want. Since owning a home involves many upfront costs as well as ongoing costs for maintenance and repairs, it's important to evaluate your current spending to make room in your budget to build a savings reserve for home expenses. All right, so let's meet Christina and look at part of her spending action plan. Christina is a single mother with a 10-year-old. She currently works 2 jobs. She created a spending action plan that includes her current expenses and itemizes her recurring expenses. Christina's spending action plan has 2 sets of expenses, needs and wants. Needs, in this section, Christina used the itemized sheet to write down necessities she pays for each month and how much they cost. Wants, in this section, Christina wrote down the non-essentials she spent money on this month and how much each of them cost. You can track this for yourself as well. So by looking at her numbers, we can ask ourselves, how much could Christina save this month? What could she have cut back on to increase her savings? Are there exceptions to spending on some of the ones listed on the worksheet? And where are they? Now that you have seen Christina's spending action plan, let's take a look at how you can start one for yourself. So you can use a worksheet to plan your financial future. Having a list of things you spend money on is helpful in 2 ways. 1, you can track your spending. It can show you areas where you could have saved money. Reducing spending on even small items could add up over time. Identifying exactly where your money goes each month can be a powerful exercise. Cutting on or lowering some of your expenses can free up money to set aside for a down payment, future mortgage payments, or other home-related expenses. And 2, you can track what you earn, which can give you a clear picture about the following: what kind of house you can afford, how much of a down payment, if any, you can make, and how well prepared you are for the extra cost associated with home ownership. Creating an action plan is something that is very, very recommended. So it's a good idea to make a spending plan like Christina's. Include your family members if possible. It helps when everyone understands the goal and works toward it together. So now let's talk about turning that spending plan into a savings plan. Whether you need money for the down payment, closing costs, or incidental expenses associated with owning a home, it's smart to start saving now to put yourself in the strongest financial situation possible. Creating an action plan. So evaluating and making changes to your spending and savings habits is an important step to take as you assess your readiness for home buying and prepare for owning a home. So now that you have an idea of what financial readiness means, let's discuss how your finances affect how qualified you are for a mortgage.
So, another of the 5 C's is capacity. Capacity is your present and future ability to make your payment obligations. One of the calculators lenders use to determine your capacity is your debt-to-income ratio, or DTI. Lenders use DTI to predict whether a borrower will be capable of making mortgage payments or repaying debt. DTI is calculated as follows. Divide your total monthly debt, including your mortgages, and other payments by your total monthly income before taxes or deductions. Multiply that number by 100. The result will be a percentage, which is your DTI. In general, the lower your DTI, the better your balance between debt and income, and the more likely you'll get approved for the loan. Let's meet Marta and see what her DTI is. Marta is paying off student loan and car loan while also trying to pay down some credit card debt. So we can see that she's got, her monthly payments here of $300 for her student loan payment, car payments at $400 a month. So we can see she's got a lot of payments she's making every month here. Let's calculate Marta's total monthly debt by adding up all of her debt payments. Her monthly debt payments of $300 plus $400 plus $200, which equals $1,700. Calculate DTI. DTI equals total monthly debt divided by total monthly income. Let's find out her DTI. We know her gross monthly income is $4,000. To calculate her debt to income ratio, we divide her total monthly debt payments, $1,700, by her total monthly income, $4,000. The result is 0.425, which is 42.5%. Another way of describing DTI is that her debt of $1,700 is 42.5% of her income. To qualify for a mortgage from a financial institution, your DTI must be lower than 43%. Borrowers with higher DTI percentages may have more trouble making payments. Will Marta's DTI of 42.5 make her more or less likely to get a loan? I think it's going to be more likely. She's below that 43%. Although it's not the only factor that lenders consider, her DTI of 42.5 is below the recommended of 43, so she may be a good candidate for the loan. Okay, if you want, you can do this at home on your own, on a piece of paper or in Excel. You can figure out what your own monthly household income is before taxes, and then divide that by your expenses to get your own DTI. Multiply that by 100, and you'll have your percentage. If it's above 43%, what are some ways you could improve or lower that number? Avoiding additional debt while paying down existing debt as quickly as you can will help you lower your DTI. Increasing your income can lower your DTI as well. You have learned that your capacity or ability to pay bills and repay loans is important to lenders. It also affects your credit score, which is another factor that can have a big impact on the type of loan you qualify for.
Your credit score reflects how responsibly you have paid bills or debts in the past. It plays a major role in your ability to obtain financing. Lenders consider your credit score when determining whether to approve a loan and how much they'll allow you to borrow. When you apply for a loan, your lender will ask for your social security number so they can order your credit report. The report will show your history of debts and repayments for bills such as credit cards, student loans, and car loans. Then the report will also include a score base of your history. Financial institutions use that score to assess your risk level as a borrower. Several companies, such as FICO and Vantage Score, provide credit scores which generally range from 300 to 850. A low number generally means that a person is considered high risk, and a high number means that the person is considered low risk. Credit scores are determined by looking at information recorded by the three major credit bureaus, Equifax, Experian, and TransUnion. Higher credit scores may help you get better mortgage interest rates. Request your credit report and review it for accuracy. Take any necessary steps to start improving your credit score, like making on-time payments. The Fair Credit Reporting Act allows you to receive one free copy of your credit report each year from each of the credit reporting agencies. You can go to www.annualcreditreport.com homeownership.com to request your report. What is the most significant effect your credit score can have on being approved for a mortgage? Do you know your credit score? If not, do you know how to obtain your credit report? How can you protect and improve your credit score? What steps will you commit to take to improve your credit score? These are some very important questions. So let's discuss some tips that might help improve your score. Use your available credit wisely. Use less than 30% of your available credit every month. And do not max out your credit card. Pay your bills on time. Pay your bills on time every month. Late payments will drastically lower your score. Review your report. Check your report occasionally. If you see any errors, report them to the credit bureau. And limit credit applications. Applying for too many cards or loans in a short period of time could lower your credit score. If you plan to apply for a mortgage in the next 6 to 12 months, try to avoid applying for a new credit card. We have learned how to assess your financial situation to help you better understand how you will be evaluated by lenders. Now, let's take a look at the costs associated with home buying.
Okay, this is a fun one for me because I'm just going through all this right now. So, understanding your costs associated with home buying can help you better understand, can help you be better prepared to make all the necessary payments responsibly. Commonly discussed home buying expenses include down payments, mortgage payments, real estate taxes, and homeowners insurance. But there are other costs that may not be very well known. They include costs such as title insurance, closing costs, inspection fees, appraisal costs, just to name a few of them. There's a whole lot more going into it, so if you do have a realtor already, or you have questions about these, feel free to go to your local bank or your realtor and ask them questions. They'll be able to help you out tremendously on that.
Okay. So let's first look at the cost associated with the purchase price of a home. Most buyers use a mortgage to purchase their home. They use their own money to pay for a portion of the price of the home, and they borrow the rest from a lender. A down payment is an initial payment toward the purchase of a home, and is typically between 3% and 20% of the purchase price. Your savings, loan size, and credit score will determine the actual amount. In general, the larger your down payment, the lower your monthly mortgage payments will probably be. Do you think it is possible to purchase a home without a large down payment? Yes, but your payments will be higher. While some buyers qualify to buy a home without a down payment, most people put some money down. The more money you're able to put down, the lower your monthly mortgage payments and interest rate is likely to be. You might qualify for a low down payment mortgage through government-backed agencies such as the Federal Housing Administration, or FHA, U.S. Department of Agriculture, USDA, and Department of Veteran Affairs, the VA. We'll talk about this shortly. Okay. I forgot to mention that we're looking at two cases. So we have two cases. On the left side, we have scenario A, where so in this case, we have Marta who wants to buy a house that costs $80,000, and we can see how having a down payment can affect her interest. So in case A, which we mentioned, Martha doesn't have any money for a down payment. And in case B, Martha has saved $20,000, so she only needs to borrow $60,000. So as a result of that, her interest rate is lower, 4.5% versus 5%. And the monthly payment that she's going to make is $2,700 versus $3,900. So Martha is saving $1,200. So this tells us how having a down payment can help you. So basically this means that you are lower risk for the bank. So financial institutions tend to recognize buyers with down payment as being better prepared for buying a home and less of a risk. Because buyers with a down payment are investing some of their own money, there is less of a risk that the borrower will stop making their payments. Doing so could lead to the bank taking the home and the borrower losing the money they used for the down payment. Since there is risk of non-payment is lower, lenders are willing to offer lower interest rates. The down payment is only one of the costs associated with a home purchase. You'll also incur other costs before, during, and after the home buying process.
It's not easy to know how much money you need to save when you're preparing to buy a home. Let's explore some more of the expenses you'll encounter during the home buying process so you are better prepared once you're ready to buy a house. When you buy a home, you generally pay all of the costs associated with the transaction. However, depending on the contract or state law, the seller may end up paying for some of those costs as well. As we discussed, lenders will check your credit score. Buyers are usually responsible for paying a credit report fee, which ranges anywhere from $20 to $50. It varies by institution. You'll also be subject to local real estate taxes. Your local government provides services such as trash collection, recreational areas, public schools. To pay for these services, your city will charge a tax on your property. This tax is called a real estate tax or property tax. Homeowners are responsible for this cost as well. Next is the inspection costs. It's highly recommended that you hire an independent inspector to assess the home's issues or maintenance needs. Buyers are responsible for the cost of the inspector, but the seller may agree to pay to repair any identified problems, or, an alternative, may reduce the purchase price to compensate. The inspector provides a detailed report of all aspects of the home, including the quality of the roof, plumbing, appliances, gutters, heating system, and so on. I will say, this is a fun process to be part of. I just went through it myself a couple weeks ago. It is fascinating, everything the person looked at. Next, you have your repair costs. Repairs are noted on the inspector's report. Usually the seller will agree to fix any problems, but sometimes the buyer will be responsible. And then there's appraisal costs. Appraisals are often requested by lenders to ensure that the value of the home matches the purchase price. The buyer may be able to negotiate these fees and have the seller pay them. Next, there's also ongoing costs. Expect the maintenance of your home to cost between 1% and 4% of the home's value each year. You might encounter expenses such as hiring pool and yard maintenance services, making repairs as needed, updating appliances, or similar obligations. You might also take on more expensive projects like replacing the roof or renovating the kitchen, which makes some years' maintenance costs much higher. So what are some of the costs listed here that we're already aware of? Obviously, the down payment was one of the big costs. Taxes were another one. So there's some of that fun stuff. Some costs listed here that many people don't think of. That's the appraisal, and ongoing costs are one that people don't normally think of. Are there any costs that we haven't thought of? Let us know. And what costs would concern you the most? You need to be aware of all this when you're purchasing a house. Closing costs are another upfront cost of purchasing a home. Since this is a large expense to save up for, it's helpful to know the expenses included in your closing costs.
Closing costs are expenses over and above the purchase price of a home. They're paid at the end of the home buying process, when the deal is closing, and when, in many states, the title of the house gets transferred from the seller to the buyer. Closing costs may include, but are not limited to, the following: appraisal fees, tax service provider fees, title insurance, government taxes, and prepaid expenses such as property taxes, homeowners insurance, and interest until your first payment is due. However, you may be able to negotiate or bargain for the seller to pay for some of these costs. People commonly estimate that closing costs are between 2% and 5% of the purchase price of a home, but they can be more or less depending on the location and value of the home. You won't know exactly how much closing costs will be until your lender provides you with a detailed estimate of all the costs associated with the mortgage. Check your state laws to learn more about the fees and charges you might be responsible for as a buyer, or call a lender and ask them if they could provide you an estimate. Now that you know about the home buying process, let's look at insurance costs you might need to account for.
Some mortgage options allow you to make a down payment of less than 20% of your home's price. But when you put down less than 20%, you will generally have to purchase private mortgage insurance, or PMI. This requirement varies by lender, but let's cover the basics very briefly. What is private mortgage insurance? A buyer purchases private mortgage insurance to ensure that the lender will recoup the balance of the mortgage in the event that the buyer defaults, is unable to pay on the mortgage. The cost you pay for PMI varies depending on the size of the down payment and the size of the loan. PMI protects the lender, not you, if you stop making payments on the loan. Why would a lender require mortgage insurance? Because it reduces the lender's risk. PMI enables buyers to qualify for a loan they might not qualify for otherwise. The cost of insurance will be added to your monthly mortgage payment. PMI costs about $30 to $70 a month for each $100,000 you borrow. The good news is that once you have a 20% equity in your home, meaning you owe 80% or less of the home's value, you may be able to cancel PMI and reduce your monthly payment. Let's say you're buying a home for $100,000 and putting down only $5,000. Since you were borrowing $95,000, which is 95% of the home's value, you are over the 80% threshold and will need PMI. If real estate values in your neighborhood increase and your home is now worth $150,000, even if you still owe the full $95,000, you can eliminate the PMI because now you owe less than 80% of the home's value. The mortgage insurance discussed so far is associated with conventional loans that you may receive from a bank or credit union. But there are other types of loans available. Let's take a look at some of them now.
Typically, when you think of a mortgage, we imagine a conventional loan that we can get from a financial institution, such as a bank or a credit union. But there are other types of loans as well. Let's find out what some of them are and the differences between these loan types. Conventional loan typically are offered by banks, credit unions, or mortgage companies. Requirements may vary depending on the lender and your credit worthiness, including your credit score and debt-to-income ratio. Government-backed loans are loans that are guaranteed by government agencies for buyers who may not have a good credit history or enough money for a down payment. Some examples include the following: Federal Housing Administration, FHA, insured loans. The FHA helps insure loans through private lenders to borrowers who have low credit scores or limited funds for a down payment. Department of Veteran Affairs, VA, insured loans for eligible veteran service members and surviving spouses. The VA can guarantee a portion of a loan from a private lender. U.S. Department of Agriculture, USDA, Rural Development Services Loan Assistance. For those looking to buy a home in a rural area, the USDA offers several types of loan assistance for direct loans and guaranteed loan programs. USDA assistance programs typically are targeted to low and moderate income individuals. Although government-backed loans help people who otherwise wouldn't be able to buy a home, there is a limit to the amount of money that can be borrowed, and insurance rates on some loans, such as those offered by FHA, USDA, or VA, tend to be high. Be sure to research the mortgage insurance that is associated with your specific type of loan. Now that you've gained all of this information about the home buying process, let's address a question that most of you probably had at the very beginning of this workshop. What price range can I afford? Although lenders ultimately will determine the loan amount you'll qualify for, you can still get an idea of your affordability range. You can save a lot of time by only looking for homes that are within your reach. We discussed earlier that there are two methods that you could give a quick general idea of the home price ranges you can afford. The 2 to 3 times your income rule and the 28% of your monthly income rule. So let's test these methods. Okay, so to do this, I would like you to write down how much money you make in a year. Okay, so how much can you afford for a down payment? Write that on a paper. How much do you earn per year? Okay, now you can multiply your yearly earnings by 2. Write it down. Multiply your earnings by 3 and write down that number. So that's the first rule. You can also use the 28% of monthly income rule. So how much do you earn per month before taxes? Divide your annual income by 12. Multiply this number by 0.28, write down that number, and this is how much you can afford to pay per month in housing cost. Did this activity result in the amount you expected? You want to approach home buying from a knowledgeable and informed perspective. Knowing the results from this activity can help you refine your future house search. It's important to remember that these calculations are just rules of thumb. Your situation can vary, so it may be helpful to work with a financial expert to determine your home buying budget. With the knowledge you have gained today, you should be able to assess whether buying a home is the right choice for you. So, this concludes our...
No, not yet. There's some free resources that you can also look into for home buying stuff. We have the links here we can send to the library if anybody would like any of these. But mostly it's the Truth in Lending Act. It requires that buyers be given information about key features, costs and risks of mortgages, including loan estimates and closing disclosures. There's also the Consumer Financial Protection Bureau, with that website right there. I'm not reading that whole thing out, sorry. That provides protections and resources for buyers when financing a home. And then the U.S. Department of Housing and Urban Development website that has all the helpful resources, has a ton of helpful resources, including fair housing, equal opportunity for all, information about borrowers' rights, home buying programs, all that fun jazz. And then USA.gov, you can also find so many more things there that go along with all of this. Again, if anybody needs them, let them know here at the library, and we can send the links over as actual links that you can click on.
Okay.
You have learned that while some factors, like home prices, are beyond your control, other factors that help you prepare for homeownership are within your control. Many aspects of buying a home are interconnected. Generally, the better your credit score, the better interest rate you may secure. The larger the down payment, the fewer costs you may incur. Homeownership will be within your reach if you do the necessary prep work needed, such as save for upfront costs, maintain a satisfactory credit report, and understand your financial situation. Use each section of this workshop to help guide you through the process, from listing your services and savings to finding out your credit score and calculating your DTI, to understanding mortgage insurance and home ownership costs. Ultimately, you will be able to check off all the boxes of assessing home buying readiness checklist and be on your way to getting your dream home. This workshop has helped for me. It helped me get through a lot of the home buying process. I actually close my home next Friday, so it does work. It does help you get there. Deciding to buy a home is a big step, but it doesn't have to be intimidating. Knowing the right questions to ask and the steps to take to get started will help you make the right decisions. Thank you very much.